Hello, everybody. And that was a fantastic lecture by Philip. I always think he's one of the best in the country on demergers and reconstructions, and showed a lot of expertise there. So come to my talk now. We are looking at exit planning now. So having maybe got a part of a reconstruction, the trade into a separate company, as you can see in the case study, we were thinking maybe of getting a corporate sale underway of the trading entity. And what I'm going to look at now is some of the issues that you come across when we're looking at company sales. So you can see here I'm very much a fan of the blockbuster board. We're going to go from left to right, certainly from my point of view. First of all, I thought it was worthwhile doing a bit of refresher on business asset disposal relief. Remember, BADR is the new nomenclature of what was formerly entrepreneurs relief, ER. But I do have to write this down frequently to remind myself that I don't call it entrepreneurs relief anymore. So it's BADR. And that's all about really getting some of the basics right. And I do find on actual transactions, it's quite amazing how many simple mistakes get made even at a sort of basic level in terms of share ownership period and so on. Then I want to deal with some aspects of how we structure the sale consideration. And the two main areas really is, first of all, looking at BADR and the interaction with loan notes that get issued as part of sale consideration. And then lastly, earnouts and of course BADR. And of course the common theme here is that prior to the budget day, March 2020, we were looking at a £10 million limit for BADR or the older ER, but now of course we only have £1 million limit. And that gives a lot of more to think about in terms of the way we structure things like loan notes and earnouts, and whether we decide to take the charge at the date of the transaction or defer the charge to a later year. So just a bit of a refresher then on business asset disposal relief. Remember, the rules did change quite radically a few years ago, and now the qualifying period for BADR is 2 years up to the date of disposal. So you need to have satisfied all these conditions throughout okay, the 2 years leading up to the date of the share disposal. And one thing that we do often sometimes get wrong, we find, is that people think that the shares have to be owned for 2 years. Well, actually, that's only partially right. As long as we've owned the or satisfied the personal company test, and you can see here that the key ingredients of the personal company test is you have to own at least 5% of the ordinary shares and at least 5% of the voting rights. And of course, the other test that we also need to satisfy is that we have to satisfy one of two alternative economic tests. And either one of those tests is 5% of the assets profits that will be available to equity holders on a winding up. That would suffice in the case of a company with a single class of shares. But if you've got a number of classes of shares, i.e. more than one, then we normally look at the other test, which is basically, will the shareholder have at least 5% of the sale proceeds on the sale? And providing we've met the 5% test, that ordinary shares, voting rights and sale proceeds, then it doesn't matter whether we acquire shares, some of those shares sometime in this 2-year period. So if, for example, I have a 10% holding in the company, and maybe I acquire another 10% in the 3 months before the sale, then all that shareholding, the two 10%, would qualify simply because of the fact that I've satisfied the 5% personal company test throughout the 2 years prior to the share disposal. Clearly, we've also got to work for the company. And that's another thing that some people sometimes forget, is that whilst it doesn't have to be full-time employment, you need to be doing some work. And I do know that one of the checks that HMRC often carry out when they're looking at the competency of a BADR claim is they make sure, is there a pay-as-you-earn record? In other words, has pay-as-you-earn been paid by that individual in that period? Because if there's no PAYE payment filing, then there is an assumption possibly, are they really employed by the company? So do make sure that these fundamentals are managed properly. And the other thing, of course, is that you've got to be dealing with a trading company or holding company of a trading group. And of course, one of the things that Philip spoke about was actually when you've got a hybrid company, maybe mixed trading and investment, how that you wouldn't normally qualify for BADR with a company with substantive investments in. But if, of course, you do a demerger and take the trading company out, so it's a clean trading company, then, of course, you would qualify for BADR. But you do need to satisfy this qualifying period of 2 years. And whilst you can look through a demerger transaction, you need to be qualifying as a trading company throughout that 2-year period. So whilst you can look through the shareholding in terms of a demerger transaction, you need to make sure that on the other side, i.e. pre-demerger, that you also satisfy these rules. Okay, so moving on then to the case of Potter, I just wanted to remind you that this is actually quite an important case that came out last year, and caused us to think quite carefully about how we go about defining whether or not we have a trading company. As you know, HMRC guidance says that in determining whether or not you've got a trading company, and the law says, of course, is that you've got to be entirely trading, wholly trading, but of course you can have a de minimis level of non-trading investment activity. And the Potter case told us that yes, under HMRC guidance, we look more than just the assets of the company. We really need to understand what the company is doing, and therefore we look to more of the activity type measures. This could be the sales of the company, the expenses of the company, the profit earned by the relevant activity, and furthermore, employee and management time. And when we looked at the Potter case, this was a case that basically, quite a sad story really, that the Potters, Mr. and Mrs. Potter, were engaged in broking activities on the London Metal Exchange. And they were affected by the last financial crash way back in 2008-9. And the appetite for metal trading almost entirely evaporated as a result of the financial crash, and therefore their business totally dried up. And they issued their last invoice in March 2009, and the balance sheet was fully made up of cash. And Mr. Potter thought that what he would do is he would buy investment bonds to earn some return on them, £800,000 you can see there. But during this period, he was struggling to revive the business. So he was trying to secure new contracts, didn't have much success, had a few personal problems as well. And the crux of the case was to decide in the period leading up to the liquidation, was the company a trading company for what was then entrepreneurial purposes? And it was actually a fairly finely balanced decision. Justice Marilyn McKeever basically said that when she looked at this on balance, the company was still engaged, as it were, in trading beyond March 2009, even though it had virtually no or little trading income in that period, and the balance sheet only showed investment bonds. But she said that really what really mattered was the fact that Mr. Potter was still trying to go about business. So in terms of the time that he spent, there was no time spent on actually the investment bond activity, but he was still trying to trade and finding new customers. And on that basis, again, despite the balance sheet breakdown, it was held to be a trading company. So this is quite an important decision, bearing in mind that people sometimes get worried about excess cash balances. Yes, sometimes excess cash balances in a business might impinge on the BADR trading status. But what we see, of course, and I've had experience of this in a number of cases where there is substantial cash carried by the business, it really all boils down to what the business is actually doing. So the P&L type measures are more important, i.e., is the sales mainly virtually wholly trading? Is the expenses virtually all trading? And is management time and employee time virtually all trading? If you tick those 3 boxes, then I would have I think we would have a very good chance of succeeding in arguing that your company is trading for BADR purposes. So those are the main rules that I've set out there. And of course, in the case study, we have the 2 Petes, I think it is, or Peter and Pete, and we would need to satisfy all these conditions in the 2 years leading up to the sale of our trading company, with which sells and manufactures and distributes exciting football strips. Now, we're moving on to just to reinforce this point about the reduction in the limit. And I think this does actually involve a change in the way we structure transactions, because now, of course, we only have a limit of 1 million, the lifetime gains limit, and that is for deals that were effectively contracted after budget day, 11th of March 2020. And although I don't want to get into too much detail here, do be aware that, and like all the other changes that we've had to taper relief and retirement relief over time, we have specific anti-forestalling provisions for people who indulged in certain transactions to try and secure a higher level of entrepreneur's relief by engaging in pre-budget day transactions. And you need to look closely about this, where in these provisions, where maybe you've entered into a rescindable contract or you've done some form of share for share exchange to effectively lock in to a pre-budget day ER limit. So do be aware of those. I'm not going to spend any more time on that because that's not really current transactions that we're doing. So here is our case study, just to, how we might end up after we've brought in some EMI shareholders. You'll see here that Pete M has got 47%, and I've got 47%. And of course, we agreed that we would bring in the employees through an EMI option scheme on the sale. So quite often, as you know, and I think that Philip Hare mentioned this, is that we often have these as exit options, so that the EMI options only become exercisable shortly before the sale of the company. And of course, what that does is dilute the existing shareholders when those options are exercised. In our case, we've got very substantial shareholdings, and therefore we won't be diluted below the 5% requirement that we've seen for the personal company test. But in certain cases, if you've got a broad shareholder base, you need to watch out for what happens when those EMI shareholders exercise their options. Will they dilute any shareholder below 5%, in which case they would lose their BADR relief. But of course, HMRC have said that they don't mind providing that dilution takes place on the day of sale. But that's quite rare in practice. But if you want to make sure you don't have a dilution that affects the shareholders, then you need to conclude the EMI option shareholders exercise their options on the same day as the sale of the company. One thing also that we need to just mention here, although I don't want to spend too much time on it, is that when the EMI shareholders exercise their option, if it was an unapproved option, of course, there will be a massive tax charge on that exercise by reference to the difference between the market value of the shares immediately prior to sale and the option exercise price. Now, if it was unapproved, of course, that will be subject to effectively employment income charge. But of course, with EMI, the main benefit, of course, is the EMI relief, is that the exercise does not create any employment tax charge, but the shareholders do acquire the shares effectively at the original cost. So the difference between the market value and cost effectively falls into the CGT regime, not the employment earnings regime. But do be aware, of course, the company will be able to claim a corporation tax deduction for the difference between the market value at the date of the option exercise and the exercise price. And of course, if you're a seller, you shouldn't forget that, because that creates value, and sometimes substantial value in the company, the benefit of that corporation tax deduction. And you should be looking to factor that into the sale price negotiation. This is actually something I did just learn that they have discovered water on Mars. There you are. Killed my sense of humour anyway. So now I'm going to move on to the loan note interaction. And before we do this, I think I wanted to just remind you of the difference between qualifying corporate bonds and non-qualified corporate bonds, because the deferral works in a different way in relation to each type of loan note. So if we had had a QCB issued as part of the deal, then do remember that a QCB is a non-chargeable asset for CGT purposes. And that's why when we come to the disposal of the shares in exchange for the loan note, and I've attributed here £1 base cost to our £100 loan note, just to illustrate the principle. So when the loan note is issued, let's say we sold our company today and we had a QCB, and of course that 100 could be a million, 100,000, but let's assume that we take 100 units to see what's going on. Then there is a disposal for CGT, a deemed disposal, but the gain effectively gets postponed under section 116 subsection 10, and that is carried forward until the date in which the loan note or part of it, as it were, gets repaid. So if all the loan note, if all that 100 gets repaid in October 2022, then all that gain becomes taxed in October 22, but we don't have any gain taxed at October 2020, i.e. the date of the deal. Now, you may say, well, that's what's the issue there? Well, the point is, if you don't get your money in October 2022 because the buyer is in default, and maybe the buyer then becomes liquidated, and the liquidator tears up the loan note because it can't be repaid as an unsecured creditor, then of course you end up being taxed on the gain without the money. So that is not a good position to be in. Now, if we have a non-qualifying corporate bond, then the difference is that it's a chargeable asset. So we don't have to do any postponement of gain at the date we receive that loan note in exchange for our shares. But effectively, a non-QCB is treated exactly the same way as shares that you receive on a share-for-share exchange. So when we effectively sell our shares in the target company in consideration for the issue of non-QCB securities in the acquirer, then all we've done there is a form of share-for-share exchange, and the non-QCB effectively steps into the shoes of our old sale shares. So whilst we have 100 loan note issued, as it were, the base cost of that loan note is still £1, i.e. the base cost of our shares. So when we come to dispose of the loan note, i.e. by virtue of the repayment of the sale consideration, you can see what's going on here. It's a disposal of a chargeable asset. The sale proceeds are 100, yes, and then less the £1 acquisition cost. So you have a £99 gain. So exactly the same gain that you had with a QCB. But the difference, of course, is that if you only receive £1, or in fact no money for the repayment of the loan note, then you don't have a gain, because the proceeds then become £1, base cost £1, and therefore you avoid any gain being crystallized if you have a worthless loan note. So non-QCBs, very importantly, give you a form of effective bad debt relief. Now, there's a further complication, of course, is that what happens if you want BADR to be enjoyed on the loan note? Well, basically, unless you've got a qualifying shareholding in the acquiring company, which Pete and I may not have, then if we don't use all our £1 million BADR limit up on the sale of the shares in terms of the cash consideration, we might want to do that for the loan note element. But of course, the key point here is if we make an election, as you can do, because you can make an election for a QCB and also a non-QCB, you can elect for the loan note to be taxed at the date of the transaction to enjoy business asset disposal relief on that loan note consideration up to your £1 million limit, taking all the consideration into account. That gets you there by making an election. But of course, what you do in both cases is you lock into that tax charge in very much the same way that with the QCB, we've locked into that gain. And unfortunately, there is no way of unwinding that tax charge because it's locked in. So that is another factor that you would need to consider when you want to make a loan note election to get BADR. Of course, there is another issue, even though that you're not looking to obtain a BADR on the loan note. If you were a sort of a man who thinks, well, actually, capital gains tax rates may increase in the future, as they may indeed do, then you may prefer to pay tax on the default CGT rate of 20% now, rather than risk gains being taxed as income, possibly in a future year. So another reason why you might want to elect for your loan note to be taxed now, of course, is to lock into a current low CGT rate, bearing in mind the money is on some form of increase in CGT rates. We can't say that for certain. It's a judgment call, but you need to have that in your thinking in terms of tax planning. So here we have, looking at Pete now on the deal, let's assume that Pete received 2.6 million for his 47% interest in the company. He's going to get cash of 1 and loan notes of 1.6. And we're being bought by a company, Soccer Inc. And let's assume that Soccer Inc. Decides to issue sterling denominated loan notes, even though their functional currency might be dollars, simply to have non-QCB treatment. If, of course, Soccer Inc. issued dollar denominated loan notes, then they would immediately be non-QCBs. But to keep things simple, let's assume it's 1.6 QCB. So with an election, okay, the cash gets taxed of 1 million. The loan notes of 1.6 also get taxed now because they're treated as though they were paid now by making a section 169 our election with a QCB. So the total proceeds are 2.6, knock off the onion exemption of 12, which gives you a taxable gain, or Peter taxable gain rather, of 2.5 million, more or less. Now, Peter, of course, will have a full BADR gain limit of 1 million. That's the maximum amount that he can enjoy at 10%, which is 100. And then the remaining gain of 1.588 gets taxed at the CGT rate now at 20%. And some people may indeed prefer to make the election to get the 20% tax charge, because if that loan note gain, the alternative would be to just pay tax on the cash and take the automatic deferral, as it were, of the gain with a QCB loan note. Then, of course, Pete's tax will be just under shy of 100K with BADR, but the gain of 1.58 will be deferred. But of course, what will be the CGT rate when the loan note is encashed? That could be 45%. So something to just think about there. And indeed, of course, you don't have to make the election at the date of sale. You've got effectively sort of 22 months after the end of the tax year in which the disposal takes place to make your mind up. So you could leave things quite late to see how tax changes pan out, to see whether or not it's a good decision to elect to pay tax now or in a later year. Now, there's one point I did want to just draw your attention to, because there will be some people who have entered into previous transactions sometime well before the BADR limit was changed, before 11th of March 2020. So, I certainly did 1 or 2 share sales in 2019 where we had this sort of formulation, and that was that in the sale at the end of sort of 2018, there was cash of 1.8, non-QCB loan notes of 2.5, which were going to be repaid over 5 years. And very importantly, there was £1 million shares issued in the acquiring company. And that, of course, gave the loan note holder 6% of the equity of the acquiring company. And because they continued to work for the company, that meant that it was their personal company. And therefore, they would have enjoyed, as foreseen in 2018, they would have expected to enjoy BADR on the encashment of the loan note, because when that gain arose, it was still their personal company in which they held 5%, and therefore the loan note repayments would have attracted BADR. And of course, that was okay then, but of course, given the deal value of 1.8 and the impact of budget day 2020, when if you've already had your £1 million BADR limit, that was it. The person who's expected to get 10% on the loan note repayments, unless they've kept this under review, and of course it does require an advisor to keep in touch with their client after they've done a transaction some time ago, they could actually miss out, because whilst the loan note repayments, they expected to get 10% CGT, what will happen now, of course, they get 20% CGT under current rules. And of course, looking beyond 2020-21, we don't know what the CGT rates will be in these years. So yes, is there a way out? Yes, it is, because they can make an election, providing it's within time, to elect to tax their loan note at the date of the transaction. And if the gain falls in this period here, in 2018-90, before the budget day change, then they will get their £10 million BADR, or rather at the time, entrepreneurs relief limit. So if you've done previous transactions where the loan holder or the seller is anticipating 10% entrepreneurs relief stroke BADR for the future, and they're capped out at 1 million, then you need to take action now by making an election if you want to bring your tax, as it were, within the 10% rules. Yeah, this is something I came across a year or two ago. I don't condone graffiti, but I thought it was quite clever. But you need to be of a certain age to actually remember what that's all about. I'm not going to sing it for you. Right, and moving out to earnouts now, and BADR. I think really to understand what's happening here is best to look at the history. So if we were doing an earnout way back before budget day 2020, remembering here we had £10 million headroom for what was then entrepreneurs relief, the sort of profile that we expected to take when we had earnout transactions, and just to make it clear, an earnout really is a situation where you have an arrangement where part of the consideration is based on the future profitability or some other formula in relation to the company. And the reason why we have earnouts, of course, is because the seller thinks the company's worth more than the buyer thinks it is at the date of sale. And the way we bridge that sort of value expectation is that we have an earnout. So if future profits are earned above expectation, then of course they accrue to the benefit of the seller through increased sale consideration. So that's really why we have earnouts. And of course, before budget day 2020, if we had an earnout transaction, then we would be taxed under the general principles on the market value of the right to receive that future consideration. Remember, we have the 1980 Marin v. Ingalls case, which sets the precedent even of how we're going to be taxed on earnout. And so what we do is that when we look at the earnout arrangement, we work out how much is the earnout right worth at the date we sell the shares. And the value of that right is actually treated as part of the sale consideration. Well, that's very handy because, of course, at this time here, the value of the earnout right, given a £10 million headroom in terms of ER limit previously, all that value of the right would be taxed at 10%, with the benefit of entrepreneurs relief. And of course, the way in which earnouts get taxed is that when you actually have an actual earnout payment, that is deemed to be a part disposal of the earnout right. And therefore, you have a calculation which looks at the actual earnout payment less the pro rata value or the part disposal value of this earnout right here, which is the amount you acquired your right for. So you can see here that in terms of tax planning, and of course, as long as you've got a robust earnout valuation, you expected to get some tax, quite a lot of the tax being at 10% rather than a higher CGT rate here, even though this is probably going to be quite small. If you have a high value of the right here, and you compare that with the pro rata value, as it were, and the actual earnout payment, then the leakage, as it were, here, remember that these earnout payments do not attract entrepreneurs relief or BADR because of the fact is that they're not shares in a company. So it's a disposal of a right, doesn't attract BADR or ER, but we would expect to get that to quite a low number in terms of the calculation. And that was all very well where we had a £10 million limit, because at least £10 million could be absorbed here with a mixture of cash, loan notes, and indeed earnout right within the £10 million BADR limit. Now, post-budget 2020, if we were doing a transaction now in 2020, if we played the same sort of game, as it were, in terms of valuation, because of the £1 million limit, in the vast majority of cases, our earnout right will be taxed at 20%, not 10%, because maybe 1 million would be absorbed by the cash and other elements of the transaction. So we do need to factor this into the fact that we may now not want to be quite optimistic with the valuation of our earn-out right, because here it's an arbitrage between 20% and whatever CGT is going to be incurred in these future years. So it may well be that in terms of earn-out transactions, in doing these things, we will go back to our old ways, which we did a long time ago, before we had generous rates of entrepreneurs leave. And that is that in arranging the earn-out transaction, in the sale and purchase agreement, we said that the earn-out would only be satisfied in the form of short-dated loan notes in the acquiring company. And the reason why we did that was to give us a deferral. Because the earn-out can only be satisfied in the form of loan notes or indeed shares, but the form here would be loan notes because we've just got fixed deferred consideration with as it were, loan notes. Then by doing that, we create a form of rollover and take ourselves out of the pernicious Marren v. Ingalls treatment, which would of course tax the value of the right to receive at the date of the share sale. If that's going to be 20% or indeed some higher number, then it may well be that we would prefer to defer that gain. And the way we defer that gain is, as I've said, making the earn-out payments satisfied in the form of short-dated loan notes. And the reason why they have to be short-dated loan notes is that HMRC have told us that they will not treat a loan note as being a security unless it lasts for more than 6 months. So they have to be at least 6 months duration. And if we've got that written into the sale and purchase contract, then the earn-out right effectively becomes displaced and substituted for what is in section 138A, a non-QCB. So at the date we sell our shares, maybe for cash, and then the earn-out itself, the earn-out right effectively becomes treated as a non-QCB, which of course we know means that there is that follows part of the base cost of our shareholding, and that then flows into the actual loan notes that get issued as part of the earn-out transaction. So you've got effectively two rollovers here. One rollover being the shares for the non-QCB, which is follows through the base cost of the original shares, and then there's another rollover effectively when the deemed non-QCB gets converted in 3 places for actual loan notes, which then get repaid. But the upshot of that, of course, is that the tax point or the tax charge for your earn-out payments gets triggered in these points here, 1, 2, and 3, and therefore you suffer whatever the prevailing tax rate is. Now, of course, you may not want to do that if you think tax rates are going to go up in future. You may want to pay tax on the earn-out right. Well, you can actually elect, as it were, to dispense with this treatment. You can elect out of section 138A, and that therefore will bring you back to a sort of quasi-cash deal. So you've got flexibility there, and I suspect this will be the way forward in a number of cases. So, just to sort of wrap up, really, and I do look forward to receiving questions for the Q&A session, which you know where to post, as we've shown you throughout the day. The first thing that you're familiar with is the £1 million BADR limit. Remember, 10 million is no more. It's 1 million from the 11th of March 2020. I've showed you some of the implications of dealing with EMI shareholders on the sale of a company. Don't forget the fact that the company, in many cases, will pick up a large corporation tax deduction. The seller needs to be aware to make sure they get some credit for that in the sale price. We've looked at BADR efficient shareholding structures. By that I mean is that given the fact that we've only got £1 million BADR limit, there is some virtue now maybe to transfer some shares to the spouse. That cannot be done immediately before the sale transaction. Remember that if we transfer shares to a spouse, unless it's already their personal company, they will have to satisfy the BADR conditions in their own right. So if a spouse owns no shares in the company and we want to have the benefit of another £1 million BADR limit, 2 things need to happen. The spouse needs to have at least 5% voting rights, ordinary share capital and economic rights, but also she needs to work for the company. Possibly she could be a director as well. And she has to do that for 2 years up until the date of the share sale to qualify for BADR. You cannot do this at the 11th hour, as I've told a client, in fact, just today. Then we are moving on to loan note consideration. And there are two types of loan notes: qualifying corporate bonds, non-qualifying corporate bonds. Remember now that we have this ability to lock into a tax charge now by making an election, either with a QCB under 169R or with a non-QCB under 169Q. But the effect is the same. You actually lock in the gain now, and the advantage of doing that, of course, yes, you bring the tax forward early, but you've got a lower tax rate, whether that is in the form of BADR or indeed the default 20% CGT rate. And then we've looked at how we might go about structuring earnouts tax efficiently. And really, a lot of it is about whether you take a charge up front or you take your charge downstream when the earnout actually becomes crystallized. And again, that's a trade-off between current tax rates, possibly a bit of BADR, depends on the £1 million limit, and the tax rates in future years. So quite an important area, I think, going forward, how we deal with earnouts, because with 10 million earnout limit, we actually had much more flexibility in getting a 10% tax rate. But that is a thing of the past. And that just leaves me to say thank you very much for listening. I've enjoyed your company virtually, and I do look forward to perhaps see you in the flesh, as they say, at our next tax summit. But thank you very much for listening. Goodbye.